Good morning and welcome to BloombergQuint, India's first digital live streaming business news service. I'm Neeraj Shah and you're watching Indian Open. Let's go straight to the headlines. Moody's cuts India's credit ratings outlook to negative from stable, citing the government's struggle to lift economic growth and narrow the budget deficit. India's direct tax collection for the first 7 months of the current financial year grew at 2.7% against the government's projected target of 17% for the full financial year. Raymond will demerge its branded lifestyle business into a separate entity as part of a restructuring plan. The new entity will later be listed on the bourses. And MSCI makes changes, includes Berger Paints, Colgate, DLF, HDFC, AMC, ICICI Prudential Life, SBI Life Insurance, InfoEdge and Siemens into the Global Standard Index. Yes Bank, Indiabulls Housing Finance, Vodafone Idea and Glenmark are the notable exclusions. Well, let's take a look at the trade setup for the day. Frankly, as far as the world goes, it's a tale of 2 or 3 charts, and you can very well see what's happened. Equities have gone up, and bond yields have had a spike as well. Now, this is on account of one simple thing. There is increased optimism on the trade front. Now, all the commentary that came in from White House advisors, from the Chinese spokespeople as well, led to this. And this is a set of indices which are global in nature. There's also S&P 500, of course, out here. But the trade deal hopes are fueling the momentum back in stocks. So it's stocks versus bonds, frankly, that has been the standout feature of yesterday's trade. Look at equities across the board rising. And what happened conversely is that bonds have come off and bond yields have risen 1.95%. This is the highest level for the US bond since the day after Donald Trump was elected. And noticeably, as this chart will show you, this is the US yields, of course, but the year of 2019 has seen some very large Friday swings in the 10-year bond yields, and the last 2 days is another prime example of the kind of swings that we're seeing in the bond yields this time around on the upside. So equity is positive, bonds not so much in the US market, and that showed in the wave one that the US markets did, because Dow, S&P, Nasdaq, all three did very well for themselves in the session yesterday. Nasdaq hit intraday highs, Dow 180 points higher in trade. That optimism has spilled over into the Asian screen as well, marginal at that, but has spilled over about 0.25% for Nikkei, 0.25% for Shanghai, Hang Seng down about 0.5%. The SGX Nifty has issues of its own, and it's showing that 0.5% downtick, predominantly because of that one reason, I reckon, which is the downgrade of India by Moody's. The credit rating outlook has been downgraded negative. I reckon, in my personal opinion, that this will be negative for the markets and the banking stocks in particular. And I somehow find it difficult to believe that this optimism around the world markets, minor as it is, will be able to help the Indian bourses in the session today. It is unlikely to cushion the weakness, to my mind at least. What will happen though on specific stocks is that the MSCI rejig will have its impact. So you'll probably have an SBI Life, HDFC, AMC, SBI Life in particular, because there's a large impact, and I'll talk about that a bit later on, not dwelling too much on it. But SBI Life, ICICI Bank, etc. will be notable movers. Yes Bank could be an interesting mover as well based on the MSCI rejig. So those are the set of specific stocks that the MSCI rejig will have an impact on. And of course, we'll watch out for results and the reaction to the results. So big day for earnings today. Is just a slew of names that are coming out with numbers. On the index, you have Eicher, Mahindra & Mahindra, GAIL as far as Nestle, and autos don't stop there because Ashok Leyland comes out with numbers. Team Lease is the other interesting one at the broader end of the spectrum. Then you have MRF, Narayan Yudhalaya and Equitas Holdings as well. It will be important to hear from the management what they have to say about their outlook. As also Bharat Forge and Dr. Lal PathLabs, a stock which has been hitting new highs, Dr. Lal PathLabs. So important set of numbers, as also for Bharat Forge from the auto ancillary pack. So these few names would be really important to monitor in this session today during the course of the day. However, what are the stocks that you should monitor on open, aside of the 2 nifty names, which is BPCL and Power Grid, which came out with numbers? A lot of others which might react. So Indraprastha Gas, deferred tax gain aided the profits for the stock, but Good numbers nevertheless. The results were above estimates. Industrial gas sales rose 14%. CNG gas sales rising about 11.6%. The EBITDA per unit was strong, and the higher margin CNG and the price hikes led to this. So let's wait and watch how well does Indraprastha Gas do in the session today. United Breweries, for a slew of reasons, the numbers were below estimates. The volume growth was at 6% due to elections and strong monsoon, but realizations were negatively impacted due to a wheat state mix. The gross margins were down 350 basis points year-on-year basis due to raw material inflation, and the interest cost doubled as well for the company. So not the best of quarters. It wasn't expected to be a good one, but this was rather weak. Let's see how this one reacts in the session today. And then 2 or 3 strong names, Trent, Amber Enterprises and Thyrocare. So all three would be very, very interesting to see. Trent in particular did really well because the revenues were led by strong performance by Westside, which showed a 13% same-store sales growth. So do watch out for all of these 3 names. Pretty good numbers. Let's see how they react. And lastly, 2 names, 2 sets of names. Firstly, the MSCI changes and the global standard index changes that have been done. We'll talk about this in detail, but I dare say do watch out for SBI Life Insurance in particular in this. There's Berger, Colgate, DLF, etc. But SBI Life Insurance is the more important one to monitor out here from the large cap space, as well as ICICI Bank. And MSCI index deletion, which includes Glenmark Pharma, Indiabulls Housing Finance, and Yes Bank in particular, the big one likely to get impacted. Let's wait and watch what happens here. Changes are effective as of November 26, 2019. We might see some reactions in the session today. Last but not the least, Raymond. They've announced a restructuring plan to demerge the lifestyle business and cut debt via equity issue. This one could be an active stock in the session today. However, the big one, the big elephant in the room to my mind, is Moody's cutting India's outlook to negative. That's the first thing that we talk on First Word. We discuss the implications with Ananth Narayan of SPGN Institute of Management Studies and Research. He joins in right now. Couldn't get a better voice, really. Sajid Mangat then joins in to tell us about the portfolio managers that beat the benchmark by a mile in the month gone by. Then we take a look at the Indian stocks that made the cut in the MSCI index rejig. And lastly, 3 of the country's biggest bus and truck makers will report earnings today. Yatin Mota will tell us what is anticipated. Moody's has just cut India's credit ratings outlook from stable to negative. The global ratings agency cites growth slowdown, especially in the rural areas, for the change in stance. Ananth Narayan, professor at SPGN Institute of Management, joins us right now on the phone line to speak about the possible implications. Ananth, good morning. Thank you so much for taking the time out this early in the morning. What do you make of this?
Morning, Neeraj. Look, we have to keep in mind the fact that Moody's is actually 1 notch above. The rating for India is 1 notch above that of S&P and Fitch. In fact, in November 2017, if you recall, Moody's actually gave us a surprise upgrade and took us to Baa2, which made it effectively 1 notch higher than the other rating agencies. So we are actually 2 notches above investment grade as far as Moody's is concerned. Frankly, I think the November 2017 rating upgrade was wrong. And what they're doing right now is probably reviewing that. November 2017, if you recollect, is when our fiscal issues started and when our growth was starting to stutter with the effects of demonetization and GST kicking in. And frankly, at that time, the upgrade didn't make sense. So they aren't telling us anything new. I think they're doing a historical correction of what was probably a mistake in 2017.
Citing some of the points that a few people have now been talking about for a bit, Ananth, and I think the vice president of the group wrote in that statement, and I'm sure you've gone through it, but they're calling into question mark how effective the government is in addressing the economic sluggishness, low job creation, all problems that we know, but hope that go away. And they are saying that they believe that the chances of this going away are remote.
Again, they're not telling us anything we don't know. I think the prognosis is largely right, except the part about chances being remote. Yes, we do have problems. The economy is beset with various kinds of problems, starting with our banks and NBFCs and NPA problem, real estate and construction, power, telecom, manufacturing, exports, you name it. There is a whole swathe of the economy which is not doing well. We also have issues on the fiscal balance, which is stretched beyond what we care to admit. But the good news is, all of these problems are solvable, which is what keeps us all going. The reality is, banks and NBFCs and NPAs can be resolved. This government is finally showing a lot of intent and a lot of action. Hopefully, it will get down to doing the real reforms required. Likewise, the issue in the specific sectors, power, telecom, etc., can be resolved. we can draw in much needed FDI at this point in time if we were to start to address our land, labor, and judicial laws issues. So all of the issues that we have ahead of us are absolutely solvable. So, again, nothing new that's coming out from Moody's. We are in a bit of a funk as far as the economy is concerned. These are resolvable. All eyes on hopefully the government, eye remains on the ball in respect of reforms and the stuff needed to revive the economy. So all eyes on that going forward. Again, I reiterate, there's nothing new that's coming out from Moody's. I think the statement is fair, except I wouldn't be brushing aside the possibility of reforms coming in as easily. I do hope the reforms come through sooner rather than later.
And just one, and well, all of us are hopeful of that. And frankly, as you rightly said, there has been a really, with a renewed vigor, a showing of intent from the government side on multiple counts. The question is, what does this do, therefore, to your mind, to asset classes and the reactions that we may see? If at all we see them, would they be short-lived, do you reckon, or are there consistent pressures which might indicate a trend going ahead?
Look, Neeraj, because the economy is not doing well, and because we are seeing issues on the fiscal balance and on the the fact that monetary policy is fairly easy with a lot of liquidity right now, there are vulnerabilities. The fact is our currency can be vulnerable despite the fact the current account deficit is looking low. The fact is interest rates can stay high because our public sector borrowing has gone up despite the fact that monetary policy is easy. So these vulnerabilities are there. So you can get news of this kind to trigger the sentiment and change the flows for a bit. And I think today morning you will see a bit of reaction. You will see rupee opening weaker. You could see a negative opening on the stock market. But eventually, this by itself will not bring on a medium-term change. We will eventually revert to fundamentals. And we know fundamentals aren't looking great, but we are living by the hope that the fundamentals can be addressed with some government action. So that wait and watch will continue, and I'll go back to reiterating what I said. Everything is solvable. I just hope that the reforms do come through to get the economy out of its funk.
Thank you so much, Ananth Narayan, for joining us and giving us that perspective. These moves from global rating agencies do grab headlines. I think Ananth put this into perspective. That Moody's was anyways a grade above the other rating agencies. So this is a bit of a course correction that they did to their 2017 move. Can it have a really long-term impact? Remains to be seen. For now, to my mind, I think the SGX Nifty is in part reacting to that. Let's see if there is some bit of recovery in the second half. Somehow I doubt that will happen. We're anyways at levels where a lot of people have been saying that we seem to be overbought. The RSI indicators indicate all of that. Maybe we needed a small trigger. Let's wait and watch if this is indeed the trigger. Moving on though, the advocates of coffee can investing managed to return over 3 times the Sensex in the past 3 months. Marcellus Investment Managers, founded by Saurabh Mukherjee and Rakshit Ranjan, as well as Pramod Gubbi, of course, and Ambit Capital, their former fund house, were the best performing portfolio managers over the August to October period. Sajid Mangad is standing by with his monthly analysis of portfolio management services. Sajid, unusual to see such short-term gains in concentrated portfolios of fund managers, but what's happened in the month gone by?
If you look at on a broader perspective, the month gave an average of a 2.5% return for the top 60 portfolio managers. Now remember, we used to cover 50, now we have increased the coverage to 60 there. So the average return is around 2.5% as compared to Sensex return of nearly 3.8% in the month of October. But there's quite a few portfolio managers who are standing out there, especially Marcellus is one of them, where we have seen them giving a return of nearly 24% in the last 3 months alone. And this compares to the index where the returns have been lesser than that. It's almost 7.5%, which is so 3 times returns, which is coming in the last 3 months for this fund house. So what's the market has been very volatile and choppy, and we are looking at places where returns can come in. What they have done in Marcellus is they have a 13 stock portfolio with a lot of concentration on 3 stocks, which is Kotak Mahindra, you have Bajaj Finance and HDFC Bank. These three, which comprises of nearly 27% of the portfolio. The next big is home builders thing, where they have some paint stocks, Asian Paints, Berger, and for that matter Pidilite, which is there. And all these stocks have worked well in the last 1 year also, because on a yearly basis also they have given a return of 27.5%. Remember, this fund was launched only in December of 2018, so it's just 11 months for this fund, but and they have given a return of 28%, or their asset under management has gone up to nearly 600 crores in the first week of November. That's what Rakshit Ranjan told us when we spoke to him. But that gives you a broad takeaway of how concentrated the returns are coming in. Basically, if you have a close-knit portfolio, they are going to give the return, and if it's a broad-based one, the returns are not going to come in. So that's something which is there. One thing which struck me very from the interaction which I had with Rakshit, it was basically that he said his portfolio is going to see an earnings growth of 30 to 32% in FY20. Now that compares to around 5 to 6% for the Nifty alone. So it's a huge jump, and this 30 to 32% is coming on the back of the corporate rate cut, which has also happened in the month of September, and as a result of which his earlier, so if you compare his portfolio growth last year, FY19, it was around 18%. Now that has jumped to 30 to 32%. He's seeing his earnings growth for the portfolio on a CAGR basis of nearly 20 to 25% over the next 3 to 4 years. Now he's very clear that these are not short-term bets. These bets are for 10 to 12 years, and any incremental money which is coming in is going into this model portfolio, and it's same portfolio for all clients. So it's not about valuation, because these companies have run up. What he says is that prices are not going to be driven by valuation but by earnings, and these earnings for these companies, at least he sees 3 to 4. For the 3 to 4 years, it's going to be 20 to 25%. So that's one. Among others, we have seen Motilal's new fund. Actually, it's relatively new. This is Motilal Wealth, Oswald Wealth Management. They gave a return of 8.6% in the month of October. That was interesting there. Ambit has been doing well.
Anything that they've done in that portfolio which is different from what Motilal does? Have you been able to analyze that?
No, not able to.
Because they haven't had the best of times in the recent past.
That's right. So the main fund of Motilal, has been very, it has done well,
but not as good. Yeah.
Not good as good as this. This is a small fund, compared to the bigger one, which is more than $1 billion for Motilal. This is a relatively small fund, which is there, which has been taken by the wealth management, which is there. Aside of that, you have others who have given good. There are 13 fund managers who gave a return more than the Sensex this time. Remember, we took a basket of 60 portfolio managers. Only 13 of them were able to outperform this Sensex in the month, and that's interesting because there aren't many who are able to do it. And even though we saw mid cap index going up by more than 4% and the broader index NSE 500 going up by 5%, the average has been 2.5%, which is lower than the Sensex for the month of October, which still means that there is still some pain in the mid cap and the broader market, which is there, and it's not getting so that the wholesome rally is not happening. It's only select names or concentrated names with good earnings backing them is working, and not the entire index or market.
Yeah, well, but this very interesting story would be there on the website as well. Do log on. Sajid, thanks so much for putting this into perspective. I urge everybody who's reading, though, is to not just look at this story individually, but a lot of those monthly pieces that Sajid has done to get a sense of what portfolio managers are doing. You will be able to see them on a monthly basis and then try and formulate an opinion about which portfolio manager is doing well in case you wish to follow his or her advice. Well, speaking of changes that have happened, there's a slew of changes that have happened in the MSCI index. So they have reconstituted its indices globally, and many Indian stocks have seen changes. Let me go across and try and tell you which are the stocks that stood out. For me, I mean, essentially this is the list. There's nothing that stood out for me, but the fund flows and fund outflows into some of these would be the interesting ones to monitor. So let's try and show you the additions. So the global standard index, the additions that have happened include Berger, and shouldn't surprise. Free float market cap criteria is what brokerages believe MSCI has used, and the list is out. So Berger, and shouldn't surprise, would have happened. HDFC Asset Management Company, again, shouldn't surprise that it would have happened. Colgate, strong name, likely that should have happened. There's hope of some recovery in real estate, and there's some revival in those prices, so DLF makes the cut as well. But the most obvious ones to make the cut are the insurance companies, because all of them had a significant rally. So I'm not surprised at all by the gains, by the inclusion of ICICI Prudential Life as well as SBI Life. These names shouldn't surprise. Info Edge has had a remarkable move, and that one too makes the list, makes the cut. What's gone out, and an impact from a fund flow perspective predominantly to Yes Bank, but India Bulls, Glenmark, and Vodafone Idea also get deleted from this global standard index. So that's as far as the larger names go. Now, if you take into account the small cap index, and some of the additions to the small cap index typically are also stocks which move out of the large cap index and therefore make it to the small cap index, and which is why you have names like Yes Bank and Vodafone Idea out there. But the interesting ones and the good performing ones which have made the cut include a Spandana Spurti, big move in the recent past, good performance, has done well. Polycab, and again shouldn't surprise. Navin Fluorine and Deepak Nitrite, and again a set of stocks in the specialty chemical space which have done very well. So the way people shouldn't be surprised that insurance makes the cut to the global standard index. People shouldn't be surprised that it's a lot of specialty chemical companies that are making the cut their way into the small cap index. Metropolis, and again, Dr. Lal, Metropolis, and that whole space has been doing very well. Brigade Enterprises, DLF in the global standard index. Brigade out here. There is Galaxy Surfactants, again, something in that space, in that pocket. And India Bulls, getting deleted from that large cap global standard index essentially, and making their way out here to the small cap index. Now, what does this expectedly do and these are the deletions, by the way. I just thought one name stood out for me, and that was Whirlpool. Otherwise, almost all of the other names that you see out here are companies that haven't quite, done well. I mean, Info Edge has made the cut higher, and therefore this is not a surprise. But otherwise, if you look at almost all the companies that are out here are the ones which haven't quite been able to do very well in the recent past. But the moot question is, what does this do to fund flows? Now, on inclusion in the global standard index, possible inflows into these stocks estimated, this is of course as per the Motilal Oswal estimates, ICICI Prudential Life 180 mil, SBI Life 272 million, Siemens about 140, and Berger Paints about 138. These are the expected inflows into on the inclusion of the global standard index. On exclusion from these names, Vodafone Idea, Glenmark, and Indiabulls Housing Finance are the three names that Motilal Oswal estimates. I've been told by my conversations that Yes Bank could also have substantial outflows. No estimates out here, but it could have substantial outflows, so do watch out for that as well. And then we move on to the top constituents as far as MSCI India goes. No surprise that the HDFC Bank is the top billing, about 10.14%. What's changed is ICICI Bank quite materially, a big shift in its weightage out here on the MSCI India index. Reliance stays at the second spot, HDFC at the third spot. Kotak stays out here at 4%. And the two IT names which have seen quite a bit of gyration, TCS and Infosys out there too. And lastly, the FMCG heavyweights, ITC and HUL, notably Axis Bank at 3.35%, but the big change is ICICI Bank at about 5.42%. So most of these are on expected lines. We haven't seen too much of a dramatic change into these indices. The question only is that can these changes continue, or will it bring the flows that people anticipate, or have part of the flows already happened? I must say though, before we move on, is that if you just look at what the banks have done the last 2 or 3 days, people would argue that there was some bit of preempting, but maybe not, because in yesterday's session and day before yesterday, we've seen some chinks in the armor of stocks like ICICI Bank and Axis Bank as well. So keep that at the back of your mind. That's as far as the MSCI changes go. The last piece on First Word is a preview of some of the auto names. Now, 3 of the country's biggest bus and truck makers are going to come out with their second quarter numbers today. While Ashok Leyland is a pure commercial vehicle manufacturer, both Eicher and Mahindra have other divisions as well. Yatin Mota is here to take us through what to expect from the three auto majors. Morning, Yatin. What's anticipated?
So, Neeraj, broadly, if you look at the auto companies, all of them are expected to report weak set of earnings, especially the commercial vehicle players like Eicher Motors as well as Ashok Leyland, wherein the volumes have fallen significantly on a year-on-year basis. But let me talk first about Mahindra and Mahindra. Mahindra and Mahindra plus MVML, the entire basket is expected to be under pressure. UV sales were under pressure, tractor sales were under pressure. So on an overall basis, the overall volume growth decline was quite steep in the second quarter. And if you look at all of these companies, the revenues are seen declining. If you look at the overall performance for Ashok Leyland, 47% decline seen on the top line. Because of a 45% decline, obviously, in the sales volume. Eicher Motors as well as Mahindra and Mahindra, 10% overall decline seen there. Of course, the recent price hikes will support the overall revenue growth for all of these companies. But clearly, specifically for the medium and heavy commercial vehicles like Ashok Leyland, the discounting was quite high. And hence, that is the only company today wherein we could see a realization decline. As far as profitability is concerned, clearly, there could be some pressures here. In fact, we are expecting a steep 83% decline in Ashok Leyland's profits. So, a big pressure point seen there. If you look at the margins also for all of these companies, they will be under pressure. Absolute EBITDA also would be seen under pressure on an overall basis.
Okay, what is it? Which is the number that you're watching out for the most, and within the companies as well, and between the 3 or 4 names, there is also auto ancillary majors like Bharat Forge coming out of the numbers. Which is the one that the street would be watching out for the most?
So, Neeraj, I would clearly watch out for Ashok Leyland, among the entire pack. Of course, Eicher Motors has Royal Enfield to probably support the margins. For Mahindra and Mahindra tractor, realizations would see some bit of improvement. But if you look at the overall metric for Ashok Leyland, and it is on your screen, a 44% decline in volumes, heavy discounting will clearly put pressure on the margin. In the second quarter, we have already seen Tata Motors report negative EBIT margins for their India CV business. Ashok Leyland cannot be an exception. Of course, we are expecting a 90 crore profit for Ashok Leyland, but I won't be surprised if the company also posts a loss figure. Of course, that is quite possible given the fact that the discounting was at record highs, volumes down 45-50%. So there should be pressure as far as Ashok Leyland's operating performance is concerned. It's to be seen how really do they deliver on the margin front, because that is something we'll watch out for very keenly, given the fact that the drop in volume is so severe and the costs are so very much in the fixed trajectory. That the operating leverage negative effect could be quite large for these companies.
Okay, we'll watch out for these. Thanks a lot for that, Yatin. Well, that's all that we have on First Word today, though, but lots more lined up on Indian Open. We speak to Jean Fang of Moody's Investor Service on their rationale for cutting India's credit outlook to negative. This is happening at 9 a.m. Pasupati Advani joins us on Market Open as investors take positions for the first time after the Moody's outlook cut. A very important conversation with Naveen Agarwal and Ashish Somaya of Motilal Oswal, who talk about the business and how it will move ahead over the course of the next few quarters. And then earnings dissection with Shekhar Ramamurthy of United Breweries as he speaks about the second quarter. That is happening at 9:50. Time for a short break and then full tilt towards the day's trade.